Welcome to The Deep Dive, the show where we cut through the noise to deliver genuinely actionable insights. Today, we're diving deep into PACCAR's second quarter 2025 earnings call. In these pretty dynamic economic times, understanding how a major player like PACCAR is navigating things, well, it offers crucial intelligence for investors like you.
That's exactly right. Our mission here is really to distill these often complex financial discussions, the management insights, into clear, concise takeaways, especially for experienced investors. We're here to highlight the signal, not just drown you in data without getting bogged down in jargon, unless, it's absolutely essential to unpack a specific point.
Okay, let's jump straight in then. The headline numbers for Q2 2025. PACCAR reported pretty solid revenues, $7.5 billion, and an adjusted net income of $724 million. But what really jumped out at me, I have to say, was the performance of PACCAR Parts. They hit record revenues, $1.72 billion, with excellent pre-tax income, $417 million. That's genuinely impressive, right?
Oh, right.
Especially considering they grew revenues when the overall parts market was basically flat.
It is fascinating, yeah, because those numbers really underscore a kind of foundational strength within PAPC. Despite management describing the broader market conditions as, let's say, mixed, the underlying performance was actually quite robust. Like you said, PACCAR Parts really stood out, a significant profit engine. And it wasn't just parts either. The truck divisions, they delivered solid results, and PACCAR Financial Services also had a very strong quarter. Their pre-tax income climbed to $123 million. That's up from $111 million a year ago.
Okay.
And that was driven mostly by excellent credit quality and, interestingly, improving used truck results. So while it's not signaling some kind of massive boom, these results definitely, paint a picture of a company with strong internal pillars that cushion against those external headwinds.
Right, makes sense. With those impressive figures kind of setting the stage, let's shift our focus a bit. Let's look at the forces driving PATC's performance and, crucially, what management sees coming down the road. So in Q2, PATC delivered 39,300 trucks. Pretty good number. But looking ahead to Q3, they're anticipating a slight dip. They're projecting around 32,000 to 33,000 units. So what's driving that expected slowdown? And, what did management actually say about the broader market conditions affecting those projections?
Yeah, that Q3 forecast, it reflects a couple of key things. First, you've got the normal summer shutdowns in Europe, standard stuff. And second, production rates over North America are being, intentionally matched to the current market conditions. They're not overproducing. When we zoom out a bit, look at the broader market, the estimate for the 2025 U.S. and Canadian Class 8 market is projected somewhere between 230,000 and 260,000 trucks.
Oh.
Now, this range, it's influenced by a few factors. General economic conditions, obviously, a somewhat soft truckload market right now, and also that lingering uncertainty around tariffs and the upcoming EPA 2027 policies.
So it sounds like there are definitely some significant headwinds there. Are there any particular segments, though, that are proving maybe more resilient for PATC within North America?
Yeah.
What's the global picture looking like?
Absolutely, yeah. There's a definite bright spot in North America. Customer demand in the less-than-truckload, the LTL, and the vocational segments, it actually remains quite strong.
Good.
So that provides a degree of, let's call it insulation for PTC. Globally, if we look at Europe, the projected 2025 market for trucks above 16 tons is estimated at 270,000 to 300,000. And what's really compelling there is that DIF's innovative aerodynamic trucks, they seem to be making a real impact.
Yeah.
Yeah, they're getting praised for best-in-class fuel efficiency, driver comfort too, and we're hearing really positive customer feedback on those.
That's excellent news about DIF. How is that translating into their market share over in Europe? And what's the situation down in South America?
Well, DIF's market share in Europe is actually up year to date.
Wow, okay.
Which, really reflects the strength of their product pipeline over there. South America, however, the outlook for the above 16-ton market in 2025 is a bit more muted. It's expected to be in the range of 90,000 to 100,000 vehicles.
Why the drop?
This reduced forecast, it's primarily driven by Brazil. They've had significant interest rate increases, like 400 basis points.
Ouch.
Yeah. And that certainly impacted consumer confidence and overall investment levels.
Right, that makes sense. Okay, beyond deliveries, another critical factor for any company is, of course, profitability, especially when you're facing ongoing challenges like tariffs. What did PATC's margins tell us for Q2? And what are the projections looking like for Q3, especially with those tariff structures still being a bit of a moving target?
Okay, so Q2 truck parts and other gross margins, they came in at 13.9%. Pretty healthy.
Yeah.
Forecasting Q3 margins is, as you said, definitely more challenging because of that tariff uncertainty. But the current estimate they gave is around 13%. That's assuming, of course, current tariff and market conditions hold steady. What's interesting, though, is the estimated quarterly tariff effect for Q3. It's around $75 million.
$75 million, wow.
Yeah, which is significantly more than it was in Q2. And this difference is mainly down to timing and the amount of material that was already in country back then versus now.
That's a substantial jump in the tariff impact then.
Yeah.
How is PATC positioned to navigate these trade policy uncertainties?
Yeah.
Especially given their significant manufacturing footprint right here in the U.S.
Well, it really speaks to PDC's strategic commitment, doesn't it? Over 90% of their trucks delivered in the U.S. are actually produced in American factories.
That's huge.
It is, and management really emphasized that getting clarification on these ongoing IEPA policies, those are specific environmental and trade regs and the Section 232 trade policies, the tariffs based on national security concerns. That clarification could significantly enhance market clarity, and that would benefit both the company and, importantly, its customers. They also shared some insights on that Section 232 investigation, specifically for medium and heavy trucks. They suggested maybe a quicker conclusion than the maximum 270 days as possible.
Oh, really?
Yeah, similar to what happened with the auto and light truck industry investigation. So this potential for a quick resolution, combined with the fact that they're actively working with suppliers on USMCA content, North American content, to mitigate future tariff risks, well, it really highlights a proactive strategy. They're trying to manage costs and pricing ahead of time.
That sounds like a very comprehensive approach.
Yeah.
Let's pivot a bit to their strategic investments and some potentially powerful tailwinds. What kind of capital investments and R&D spending are they planning for 2025? And what's really driving those decisions?
Right. So they're planning capital investments of about $750 million to $800 million, and R&D spending of $450 million to $480 million for 2025. And these aren't just, keeping the lights on spends. They're very focused investments. Next generation clean diesel, alternative powertrains, advanced driver assistance systems, ADS, and connected vehicle services.
Future-proofing?
Exactly. They're also investing directly in their truck and engine factories for long-term growth, which is, a pretty clear sign of confidence in their core business.
Makes sense. Beyond those internal investments, management talked quite a bit about something they called the One Big Beautiful Bill Act. That sounds, quite impactful. What exactly is this legislation, and how does it benefit PDSE and its customers?
Yeah, that name definitely catches the ear. What's truly impactful here for PATC is this specific piece of legislation. Management seemed quite optimistic about it. Basically, it provides significant R&D and capital expenditure depreciation acceleration.
Oh, okay. Tax benefits.
Exactly, and it's a dual benefit. First, it helps customers by enhancing their cash flow for capital asset purchases, like new trucks. Makes it more attractive for them to buy sooner rather than later.
Hope it's money in their pocket.
Right. And second, it provides PATC itself with substantial cash tax benefits. They estimated these in the $300 million to $400 million range.
Wow.
So this kind of legislative tailwind, it can be a really powerful demand driver. It's essentially putting more money directly into their customers' hands to buy PATC trucks.
That's a pretty direct stimulus, yeah. Another factor management highlighted was the upcoming 2027 NOx emission standards. These are set to drastically reduce emissions, right?
Yeah.
How does this regulation tie into, future customer buying behavior?
It's a huge point. The 2027 NOx emission standards, they're going to reduce emissions from, I think it's 200 milligrams down to just 35 milligrams.
Big drop.
Massive. And management specifically highlighted this as a potential catalyst for customer buying, probably starting later this year, they think.
Why is that?
Well, because these stricter standards, they're almost certainly going to lead to anticipated cost increases for new trucks. The technology just costs more.
Right.
So this creates a classic pre-buy opportunity. Customers basically accelerate their purchases to get the current cheaper models before the new, more expensive ones hit the market in 2027.
Okay, that sounds like a potentially strong setup for future demand then. But hang on. Management also acknowledged 3 months of, weaker orders recently. How do they reconcile that with their confidence for the second half of the year? Especially given this whole pent-up demand narrative they mentioned.
Yeah, that's a critical question, isn't it? How do you square those two things? Their confidence for the second half, it seems to stem from several interconnected points. Firstly, they see overcapacity gradually exiting the truckload sector, the market slowly rebalancing.
Okay.
Secondly, those big, beautiful bill incentives we just talked about. That's a direct boost. Thirdly, these upcoming regulatory emission standards creating that pre-buy incentive we just discussed. And finally, they expect tariff clarity to emerge, which should help build customer confidence back up. They specifically mentioned this pent-up demand scenario because, look, despite those weaker order months, trucks are still running. Freight ton miles are not actually low.
So the need is there.
The underlying need is there. This isn't really a demand cliff scenario. It's largely a replacement market. They estimate maybe 260,000, 270,000 trucks annually that just need replacing because they're getting old. So this kind of structural strength, when you bolster it with the strong contributions they get from parts, from financial services, and their new truck models, what really positions the company quite robustly, especially compared to how they might have weathered previous downturns.
That makes a lot of sense. So it's about the fundamental need for replacement, kind of amplified by these legislative and regulatory catalysts coming down the pike.
Yeah.
How is PACCAR's own operational efficiency and inventory management contributing to this sort of resilient position?
Yeah, they seem very focused on lean, efficient production and really stringent cost control. It's actually quite striking when you look at the numbers. Industry-wide Class 8 inventory is running around 4.2 months of retail sales right now.
Okay.
Compare that to Kenworth and Peterbilt PTC's brands, their inventory stands at a much, much leaner 2.9 months.
Big difference.
Huge difference. And it highlights PTC's incredibly strong position. It's largely down to their discipline around building to order, not just building for inventory, and also their high vocational mix. About half of their inventory isn't even sitting on dealer lots. It's actually with bodybuilders already being customized for specific customer orders.
Wow. That disciplined inventory management certainly seems to offer resilience, doesn't it?
Yeah.
Are they taking a similar approach in the medium-duty truck market? And what about their labor strategy, given these market fluctuations?
Yes, absolutely. Their discipline extends to medium duty as well. Industry inventory there is around 6 months, which is quite high. Kenworth and Peterbilt, meanwhile, are at a much healthier 4.5 months. So again, they're well positioned. And you have similar 2027 emission factors coming for medium duty trucks too, which could also stimulate a pre-buy in 2026 for that segment. And importantly, on the labor front, PTC seems to be balancing that lane production focus with actually retaining employees. They're anticipating the market improving.
Playing the long game.
Exactly. It suggests a strategic long-term view of their workforce, not just reacting month to month.
Okay, looking even further out then, what about future growth and innovation? Where do they stand on things like autonomy and electric vehicles? And what other long-term growth opportunities are they pursuing beyond just the cyclical truck market?
Right, good question. On autonomy, they acknowledged great progress being made by their partners, companies like Aurora, Kodiak, and Stack.
Yeah, familiar names.
Exactly. ATC is continuing its own autonomous vehicle platform development too, but they really stress prioritizing safety above all else, which, practically speaking, means drivers are still currently operating these autonomous capable trucks. It's not driver out yet.
Got it. Safety first.
Safety first. On EVs, it's clear they're pursuing adoption prudently. They understand it might be slower to scale, but interestingly, more expensive EVs could actually benefit PTC's business model down the line.
How so?
Potentially higher margins, more proprietary content needed, and regulations generally driving complexity often means more proprietary parts, which also aligns with their strengths in the parts business. Beyond the cycles, they fundamentally see trucks moving freight as likely to increase over time. And autonomy, when it truly scales, could actually increase truck demand by improving efficiency and utilization. And finally, they see parts, financial services, and connected services as really significant future growth opportunities because they're all critical for maximizing customer uptime, which is, the holy grail for trucking companies. That's a structural long-term driver for the whole industry.
Okay, that brings us to the big question then. What does this all mean for you, the investor, looking at PATC right now?
Well, I think there are several key takeaways here. First, you've got PATC's parts and financial services businesses. They provide this really steady foundational profitability that truly cushions the company against the natural cycles of the truck market. It's a solid base. Second, there are some potentially significant catalysts for recovery emerging. You've got policy clarity hopefully coming on tariffs in Section 232. You've got the legislative benefits from that One Big Beautiful Bill Act. And you've got the upcoming 2027 NOx regulatory standards. exports. All of these are set to create powerful tailwinds and could genuinely pull forward demand into 2026.
That pre-buy effect.
Exactly, that pre-buy effect.
Yeah.
Third, their disciplined operations, particularly that lean inventory management we discuss and their strategic investments in innovation, they position PFT exceptionally well for an anticipated market strengthening. They're ready for it. And finally, beyond just cyclical demand, PFT is strategically investing in those future areas. Autonomy, EVs, connected services, these promise more structural growth over the longer term by increasing efficiency and the amount of proprietary content in their vehicles and services. Management themselves basically said they feel pretty good about 2026 as clarity emerges and, trucks continue to be utilized, leading to that potential pent-up demand finally being unlocked.
All right, that leads us perfectly into our This Is Not Financial Advice segment. This is where we pitch an outrageous but plausible trade idea, kind of like a hedge fund analyst prepping for an investment committee. Your turn.
Okay, all right. Here's the thesis then. Given the, let's call it, emerging clarity around those 2027 NOx emissions standards, and the potential boost from the One Big Beautiful Bill Act, well, we're seeing a pretty powerful confluence of regulatory and fiscal catalysts here. These could genuinely supercharge truck demand, especially for a company like PATC that already has lean inventory and a strong product portfolio. They're set up well.
Okay, so the setup is there. What's the outrageous but plausible idea?
The idea is this. Consider initiating a long position in PAC, ticker PCAR, with a specific focus on out-of-the-money call options expiring in late 2026 or perhaps early 2027.
Out-of-the-money calls.
Okay.
For those maybe less familiar with options, walk us through the core rationale behind that specific play. Why options? Why that time frame?
Right. So, look, this isn't just a bet on a general cyclical recovery happening eventually. It's a more specific play on a forced pre-buy cycle. As those 2027 NOx standards get closer, remember, shifting from 200 milligrams down to 35, the significant anticipated cost increase for new trucks is going to create a really powerful incentive for customers to pull purchases forward into 2026.
Demand could literally jump ahead of schedule.
Get ahead of the price hike.
Precisely. Now, you couple that with the immediate cash tax benefits potentially coming from the big, beautiful bill, which directly fuels customer CapEx and also shores up PTC's own balance sheet. Well, the demand curve could steepen dramatically, maybe faster than the general market consensus expects right now. And because PTC has that disciplined build-to-order model and much lower than industry inventory, they are exceptionally well-positioned to actually capitalize on that surge. They won't need to work through mountains of excess supply first.
They can meet the demand. They can meet the demand quickly. So this is really a targeted bet on a policy-induced demand shock, favoring a company that already shows structural strength in parts and financial services, which provides a nice, robust floor, by the way. The options part, the call options, simply provides leveraged exposure to this potential, hockey stick effect in orders and deliveries as that regulatory clarity turns into actual conviction for fleet managers making purchasing decisions. It's a bet on that sharp uptick.
That was quite the pitch indeed. Okay, so to recap our deep dive today, PTC Car's Q2 performance really demonstrates a company with solid foundational profitability and pretty smart strategic positioning for future demand. And this fascinating interplay of regulation, legislation, and the underlying market dynamics, well, it could truly be setting the stage for some significant shifts in the truck industry ahead.
It genuinely highlights the importance, doesn't it, of critical thinking when you analyze these earnings calls. Because what might seem like minor details or really technical discussions about regulations can often signal major shifts in the market or create these powerful pre-buy opportunities that really impact an entire industry.
Indeed. Well, we hope this deep dive into PTC Car's latest earnings call has given you, our listener, a clearer picture of their position and their outlook. And just a reminder, of course, this discussion is purely for informational purposes. It does not constitute financial advice. If you have sources, earnings calls, or anything else you'd like us to dive into for a future deep dive, please do send them our way. We love getting listener suggestions. Thank you for joining us on the deep dive.